This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Growth versus value. It is the great investment debate heading into the new year. Where should you put your money for 2016?
Turning point. As more people shop online, what does the future hold for all of those malls and all of that real estate?
White Christmas? No way, not on the East Coast at least, and not on the slopes. And that's creating headaches for businesses that rely on snow. All that and more tonight on Nightly Business Report for Thursday, December 24th, Christmas Eve.
Good evening, everyone. Merry Christmas Eve. I'm Sharon Epperson, in tonight for Sue Herrera.
And the same from me. I'm Tyler Matheson. Welcome, one and all. Well, there was not, however, a lot of holiday cheer on Wall Street today. The Grinch, yes, the Grinch was out and about after a week of strong gains. But the major averages did manage to record their best week since late November. Volume was light on this holiday-shortened trading session, and by the early close today, the Dow Jones Industrials were off 50 points to 17,552. NASDAQ gained a whopping 2.5 points, and the S&P 500 dropped 3. For the week, all of the major averages rose about 2.5% or a little more. As for oil, it had a big week with prices for domestic crude rising roughly 9%.
But be of good cheer, there was some positive news today on the economy. Jobless claims fell to a near 42-year low. The number of Americans filing for unemployment benefits dropped more than expected last week as the Labor Department continues to tighten. Initial claims declined 5,000 to a seasonally adjusted 267,000 for the week ended December 19th.
Well, consumer spending, of course, makes up a huge portion of economic activity in the United States. And like wreaths, eggnogs, and carols, last-minute shopping is part of the Christmas tradition. This year's no different, with retailers hoping a late rush will add some sparkle to what has been a pretty tame holiday shopping season. Mary Thompson reports from the Queens Center Mall in Elmhurst, New York.
On the day before Christmas, all through this mall, some shoppers were rushing to get gifts for all.
We're last minute during the first minute of the last minute.
The International Council of Shopping Centers saying as of Monday, a quarter of Americans had Christmas shopping to do and 10% hadn't started, like Pierre Farrow.
As a last minute shopper, I think I'm definitely going to spend a lot more than I would have a month ago, but, 'tis the season.
Unlike Farrow, most last-minute shoppers tend to be bargain hunters, waiting for steep markdowns during the final countdown to Christmas. Dana Telsey of the Telsey Group says this year, though, the anticipated last-minute rush is being spurred by another formidable force, Mother Nature.
I think overall we've had a very warm Christmas in the Northeast and the Midwest. I think people have been outside, and perhaps they need to finish their shopping.
Analysts did see a pickup in department store traffic on Super Saturday or the Saturday before Christmas. Some shoppers, no doubt, unable to find gifts online.
This year, Adobe says out-of-stock online items are running about 10 to 15% higher than they were last year, as a lot of e-commerce companies gave early discounts. And now this is driving shoppers back into the stores.
But as consumers spent early online, it's hard to find some of this year's hot gifts, like Star Wars toys and Hasbro's Pie in the Face game. Sensing a trend, one couple bought in November and cashed in.
I know one of the big toys was like Pie Face, and we got it, and we had the opportunity to sell it on eBay and make a little profit on it.
The season of giving back to those who planned ahead for the Christmas rush. For Nightly Business Report, I'm Mary Thompson in Elmhurst, New York.
This holiday season, we saw a growing number of people shop online, and that number has been continuing to grow. So what is happening to all of those malls? Let's bring in Bert Flickinger, the managing director at Strategic Resource Group. And Bert, let me tell you, I'm one of those people who for the first time did every bit of shopping online. So what is happening to the malls? You say there might be an ice age starting here in the retail sector.
There's a retail ice age, Sharon, with the Darwinian destruction of some of the less well-capitalized, less capable chains. They're anchors, and as the anchors go, some of the malls roll over, and they'll either, some close, some of the shopping owners go bankrupt, some of the retail chains go bankrupt, and there'll be the massive retail rationalization between next year through 2019.
Is there a distinction to be made from the great malls with the sort of headline stores and the B and C level malls? Are those the ones that are most vulnerable?
Tyler, you're completely correct, is that malls anchored by an Apple store, by a Nordstrom, they'll be good for the foreseeable future, arguably for decades. It's the B and C malls anchored by a Kmart, a Shopko, a Sears. They're the ones to worry about.
Is it a regional issue, or is this something that we're seeing across the board, across the United States?
We're seeing it throughout the continental U.S. and our studies across Canada. We've also studied malls in the Middle East, Europe, Asia. We're seeing it worldwide. Our family company was Kaufhof was bought out by Metro, Lord & Taylor's. They survived, but Karstadt, a competitor in Germany on the European continent, did not survive. President of Galeries Lafayette said department stores are dead. With the death of department stores come the malls.
You know, obviously, online shopping is one reason that has sort of cannibalized mall traffic. Another, I wonder, is whether the move of the millennials back into the inner city cores or the near suburbs has meant that those malls that take a car to get to just aren't getting the traffic.
A very present point you're raising is workers and residents of cities tend to take mass transit, tend not to own cars. 9 million more renters than 10 years ago. They're not shopping at malls on Saturday and Sunday, and hence the shift online, as you referenced, rather than on land shopping.
So, Bert, thank you so much for joining us in studio. Very quickly, what happens to all the real estate when these malls close?
And which developers get skewered?
Two things. Some of the mall real estate becomes residential. Some, like Chrissy Hind and the Pretenders from Cleveland said, get plowed back into agriculture. The ones most at risk, diversified developers and general growth properties. They got hit in the last retail recession, likely to get hit again. Thank you so much. Bert Flickinger from Strategic Resource Group. Thanks for joining us.
Thank you for the malls, Bert, huh? All right, man. Thanks. All righty, the warm weather is sending a chill through part of the leisure economy. Instead of snow-capped mountaintops, the Northeast is seeing green grass, mud on the slopes, threatening ski businesses and businesses related to the skiing industry. Danielle Waugh has the story from New Remain.
Ski resorts in Maine are dreaming of a white Christmas vacation week, what's typically one of their busiest times. Instead of snow, New England is breaking records for high temperatures. Even the overnight lows have been too warm at times to fire up the snow guns.
It's hot. It's hotter than last year. Yeah, and the one year I bring a ski mask, it's actually too hot for it.
Sunday River in New Remain has been making snow anytime it dips to the low 30s, and they've been able to open 33 trails among all the patches of green grass.
It's actually more than we expected coming up. We didn't see much snow.
Instead of the holiday crowds, resorts have been getting cancellations.
To tell you the truth, we were thinking of canceling.
Ski resorts in the Northeast could finally get their break in the forecast early next week when high temperatures are expected to be in the 30s. There's even the possibility of real snow. For Nightly Business Report, I'm Danielle Waugh in New Remain.
To the stock market, where the Dow and the S&P 500 are basically flat for the year, despite seeing the return of volatility. But as we enter 2016, there's a big debate on Wall Street, and it centers around investing in value versus growth stocks. Bob Pisani explains.
Growth is traditionally associated with companies that are regularly growing earnings, like technology stocks. Value is usually associated with relatively flat or even sometimes declining earnings growth, but often with lower prices and a higher dividend yield. This is often associated with consumer stocks. There's a big difference in performance this year. Growth stocks are up 4% as a group. Value stocks are down about 4%. So who's going to win in 2016? Well, 2015 has been a very unusual year. A lot of energy and materials and industrial names like Marathon Oil, U.S. Steel, and Caterpillar are down 20% or more. So as the year closes out, a lot of traders are buying these beaten up names under the assumption that business will gradually improve in 2016. Well, it's easy to argue for a short-term pop in energy and materials, but making a call for these value names to outperform in 2016 is a tough sell. Here's why. For value to work, several things have to go right. First, oil has to stabilize and rise, even if modestly. Second, the global economy has to show some signs of growth. Again, even if just modestly. Finally, the Fed has to be very slow raising rates. Doesn't sound like much, but it's a pretty tall order. The consensus is that we'll get another year of below-trend growth and that oil will struggle to rise, at least in the first half of the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Our next guest says growth stocks will outpace value in the first half of 2016. He's our friend Jack Ablin, Chief Investment Officer at BMO Private Bank. He joins us now to talk a little bit more about that particular point, growth versus value, and his overall outlook for the market. You like growth, but sort of tentatively, if I'm reading between the lines of my notes. But at the same time, you think we are in a profit recession with earnings trending down yet again. That usually isn't the great recipe for growth stocks.
Yeah, it's interesting. We're agnostic. I mean, we generally will shift between growth and value. We are more favorably inclined with growth right now, and I think Bob made some valid points. You need to, for value to regain its lead, which it is relatively cheap. I mean, value is normally cheap, but it's really cheap right now. But a lot of good things have to happen and all come into alignment. And I'm not sure that's going to happen this time around, at least not yet.
Jack, you say it's all tied into credit conditions, and with oil prices low, credit will remain tight. What do you see as the outlook for credit in 2016?
Yeah, I mean, credit had really expanded dramatically with an easy central bank here at home and easy central banks abroad. The Fed now starting to tighten. That has put pressure on credit. In fact, the credit markets started to sense that stress back in April. In fact, it was about the time when the average stock started underperforming the market itself, was consistent with this tightness in credit that we saw back in April. So I think that's a trend that will likely continue into 2016, which would make heavily indebted value stocks just under that much more stress.
2015 is probably going to end, no matter what happens next week, with roughly flattish kind of gains, maybe a couple of percent for the S&P, maybe the same for the Dow. What do you expect in 2016? Will it be a better year, a similar year, what?
Yeah, it's going to be interesting. It really, a lot of it, Tyler, depends on the underlying economy. I think there are a lot of assumptions built into valuations that really didn't come true this year. And that's part of the reason why we saw sort of this just, sideways volatility. The fact is that revenue growth has been declining now for the last 3 quarters. Earnings growth has been declining for the last 4 quarters, if you include what analysts are expecting in the fourth quarter of this year. And so we really do need to see a ramp up in growth. And, a lot of the pieces are in place for that. The labor market is tight. We're starting to see wages rise. Gas prices are low. So there's a huge dividend there.
Right.
We'd like to see some spending. And, of course, based on what we're seeing in the malls this time around, it's just not there.
All right, Jack, my recommendation to you is leave that Davie, Florida behind. Come up here to New Jersey, get some warm weather, buddy. Jack Ablin, Merry Christmas, BMO Private Bank.
All right, still ahead, should you bet on blue chip stocks in the new year? Well, our market monitor is going to tell you what he's buying. DraftKings says it disagrees with the Illinois Attorney General. Late yesterday, the Illinois AG said daily fantasy sport contests amount to illegal gambling in the state. DraftKings says it will fight the ruling in court and in the meantime will, quote, preserve the status quo.
And after a rough year for technology IPOs in 2015, the names that may go public in 2016 probably aren't the ones you'd think. Josh Lipton has the details.
Only 28 technology companies entered the U.S. public markets this year. That's compared to 62 last year, according to Dealogic. And some of those companies that did make a public debut haven't exactly wowed investors. Pure Storage is trading just around its IPO price of $17. And cloud storage company Box is now some 40% off its recent high. But there are reasons to believe there could be more tech exits in 2016. For one, more startups might get dragged into the public markets. Analysts say their valuations priced them for perfection, while the results came in somewhere below perfect. As a result, the private markets may no longer be as receptive to these companies, forcing them to go public. Names to watch: Dropbox, Cloudera, and Jawbone, according to CB Insights, which tracks and analyzes venture capital. Beyond being pushed into the public markets, analysts also highlight a smaller pipeline of companies that are now solid enough to consider a public debut. CB Insights, using a range of metrics, including customer signings and hiring activity, says companies to watch include many focused on areas such as analytics, data centers, and security. The four they mention specifically: Actifio, MuleSoft, Okta, and Zuora. And even if there aren't more public debuts, there could at least be more deals in Silicon Valley next year.
I think we will see more M&A going into next year, just because some of these companies will need to have homes that can continue to fund their operations and can continue to invest in their success. And that might not always come from venture capital if you have a large valuation at this point.
CNBC talked to more than 24 VCs and tech investors, and the consensus is that 2016 could be tougher for many tech startups. A partner at Institutional Venture Partners put it this way: the cheap capital party is over. There are just a few drunk sailors who didn't hear the last call. The new mantra among venture capitalists in Silicon Valley is this: forget about those eye-popping valuations, they say, and show us the liquidity. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
A Dow component splits 2 for 1, and that's where we begin tonight's Market Focus. Nike split for both Class A and Class B common shares went into effect today. Shareholders will receive 1 extra share of Nike stock for each share they already own. And on the first day of trading at its new price, Nike's share fell nearly 2% to $63.18. Shares of SunEdison rose after the renewable energy company says it was in talks with lenders to secure a new credit facility of around $650 million. That sent shares of the company up more than 9.5% to $5.91.
Well, Sharon, Puerto Rico's electric power utility agreed to a deal with its creditors on a restructuring of its debt. The move seen as a step to fix the island's economy. Bond insurers MBIA rose 8% and Assured Guaranty gained 2% on that news. The British drug maker AstraZeneca reportedly interested in buying the U.S. drug developer Relipsa. The Daily Mail reports that an offer would be worth about $46 a share. Shares of Relipsa up more than 3% at $28.90. AstraZeneca, fractional gains there at $34.13.
Our market monitor recommends buying familiar blue chip names heading into the new year. He's Hank Smith, Chief Investment Officer at Haverford Trust Company. And the last time he was on in July, he recommended Wells Fargo, which is down nearly 6%, JP Morgan, and United Technologies, which are off more than 4%. So quickly, Hank, the first thing I want to say is happy holidays to you. And what do you think about your picks that you said previously? Do you still want to own them?
I believe so. We still own them in our portfolios, and we think their prospects are very good. In each case, you're getting a excellent dividend and dividend growth on top of that, and you're not paying much. The valuations are very attractive.
Blue chips, you say, are most attractive right now. Why do you say that, and what's one of your top picks?
Sure, we're not in the early stages of a bull market for sure. That doesn't mean this bull market's going to end, but we're at a stage where I don't think we should be speculating. We should be investing in solid blue chip franchise companies, and 3 that we like right now, DuPont. We like this deal with Dow Chemical. We'd be buying DuPont rather than Dow because we think when they merge, you're going to get a big dividend increase with the DuPont holding. GE, which has been an underperformer for much of this bull market, is now finally getting its legs and starting. It's been a good performer in the industrial space this year. You also have an activist shareholder, Nelson Peltz Tryon Group there, which is a positive. They've made the shift more toward industrials, away from GE Capital. We think that is a positive. And finally, Philip Morris International, which has been a relative underperformer the last couple of years because of the strong dollar. Our expectation is going forward, you're not going to see the dollar strength like you've had in the past 2 years, and we think money's going to flow toward Philip Morris International.
Are you concerned at all, Hank, about that DuPont and Dow merger, that it might run into some regulatory problems? And could that be a stumbling block for your thesis?
Yes, that's always a possibility. particularly with this administration that's gotten more active in blocking mergers over the past year. But there's not much there's not much overlap in these two businesses. We think they can get that through. You have two activist investors on both sides, Trion and DuPont, Third Point on Dow's side. So even if this doesn't happen, I still think there is impetus to create shareholder value with DuPont.
And we know GE very well at this company, but I wanted to ask you about streamlining toward an industrial focus and how important that is for GE going forward. Is that why you think that this company is one to watch in 2016?
I think that is a big part of it. The way they've systematically shed much of GE capital. With the new Dodd-Frank banking regulations, it really doesn't make sense for GE as it did, say, 30, 20 years ago. And so we think they're going to get a better valuation, being looked at more as an industrial company. Plus, you're getting a 3% yield. You're getting above average yield on all three of these picks, which I think is very attractive in this type of market environment.
And a key point to watch for in 2016. Thank you so much, Hank Smith with the Haverford Trust Company. Happy holidays to you.
And coming up, the big business of Santa and why companies see a lot of green when it comes to the man who wears red.
Here in the U.S., travel for the Christmas holiday is expected to break records. As we've reported, AAA says the number of year-end travelers will likely top 100 million. That's nearly 1 in every 3 Americans taking a trip, not just by car, but also by plane. Hampton Pearson is battling the crowds at Reagan National Airport in our nation's capital.
While unseasonably mild weather means no white Christmas, an improving economy, and even cheaper airfares finds lots of travelers in the holiday spirit.
I'm not used to Christmas without snow.
It's a Christmas miracle.
Christmas Eve travel so far has seen delays and cancellations at a minimum. Just over 600 delays, nearly 50 cancellations by midday, with some major East Coast hubs impacted by rain, not snow. The projected 38 million airline passengers traveling during the 17-day holiday period for both Christmas and New Year's caps what has been a very good year for the major airlines. Holiday travel alone is up 3% from last year. And lower jet fuel costs, along with the mild winter, is helping the industry bottom line.
When we have these winter seasons with very, very few cancellations over the last couple months, and looking forward for the next week, weather looks really good, combined with these terrific oil prices, it's really good financially for the airline.
100 million Americans, roughly 1/3 of the population, are expected to travel via planes, trains, and automobiles during the holiday season. For Nightly Business Report, I'm Hampton Pearson.
And on this Christmas Eve, we look at the Santa economy. There's a lot of money surrounding the man in the red suit, and companies of all sizes are taking notice. Courtney Reagan takes a look at what some call Santanomics.
Santa Claus is coming to town.
It's the most well-known job in the world, so naturally, you have to go to school for it. Santa school, that is.
I've been coming here about 13 years now.
The most important thing I learned is to be jolly.
This is the Harvard of Santa Claus schools.
The not-for-profit Charles W. Howard School in Midland, Michigan is the world's oldest, but not the only Santa school.
Holly said thanks for coming, and I'm saying thanks for coming.
Owners Holly and Tom Valent have experience on their side, starting with the school's founder.
Charlie was actually the technical director on the original Miracle on 34th Street, as far as what Santa should be and what he should do.
Founded in 1937 with a handful of trainees, this year's class numbers 130 students, and there's a wait list every year. The school now packs the learnings of St. Nick into 45 hours over 3 days.
It's a calling. You know, anybody can put on the red suit and grow a beard, but they can't all be Santa Clauses.
Now let's be clear, these are Santa's helpers, because everyone knows there's only one Santa Claus. And his helpers aren't just supporting the man in the big red suit, but an entire economy around the business of Santa, too. Santa school starts around $400. A good custom suit can cost around $2,500. And don't forget the boots, the gloves, the beard. A fake one with wig can run $1,500. But grooming a real beard costs $100 a month. Clients pay Santa anywhere from $30 to a couple $100 an hour. But for many, it's not about the money.
Paid. Cookies, milk, all kinds of cookies. It's fantastic.
Santa brings happiness and hope to children and families.
Smile for mommy.
But he also brings in traffic and in some cases revenue for malls and others like indoor amusement park iPlay America.
I think that, maybe about 10 to 15% of our holiday business is derived from the fact that we have Santa here.
Santa visits are evolving, like here at Dream Place, which is a production by DreamWorks. It has 5 rooms with interactive digital screens where kids of all ages can come to make memories with Santa, something you can't do online. Noor Programs runs Dream Place, providing the photographer and Santa staff with contracts at many of America's malls, employing over 4,000 people this year. And the Santa business is booming. Noor's sales have grown by 50% since 2010. For Nightly Business Report, I'm Courtney Reagan.
What a great holiday story.
Lucky Santa there, right? Okay.
All right, then. Well, that is Nightly Business Report for tonight. I'm Sharon Epperson. Thanks for having me this week, and thanks for watching.
And Merry Christmas to you, Sharon.
Thank you.
Great
Same
to be with
Tyler.
you. I'm Tyler Mathisen. Have a great evening, everyone. Happy Christmas Eve. Join us tomorrow for a special Christmas edition of NBR.